why do banks put their money in life insurance? And why do they put a lot of their money in life insurance? Specifically here, I'm talking about cash value life insurance. If you were to look up a number of banks, you'll see that the majority of banks in the US have a large amount of their capital, tier one capital, their tier one assets in cash value life insurance. The question that always comes up is why? Take some of the major banks, Wells Fargo, Bank of America. In the cash value holdings alone, not the actual life insurance payout, but the cash value holdings alone, they have over $20 billion sitting there continuously compounding for them. So why do they put money there? Well, there's several benefits to it, the cash value specifically, but the question that comes up is, why do they put their money there? But then after understanding it, how can I, as an individual or small business owner, do the same thing? Specifically, how do I take out this cash value life insurance, like banks, maximum cash value, not junk? Meaning, what we often see here is individuals here that big banks, corporations, wealthy individuals have utilized whole life insurance, cash value life insurance forever, and they become interested for that sole reason. And then they're presented a policy and they look at it and say, why would a bank do this? I'm just not getting it because it is not that attractive. Well, often there's a big difference there. So we're going to walk through bank-owned life insurance, what banks do with cash value life insurance. We're going to look at an actual policy that we recently put in force and then show you exactly how individuals can mimic that as closely as possible. This will mimic what a lot of the high net worth, ultra wealthy do, which is really available to anyone. We do not need to have a ton of money to do this. So what banks do with cash value life insurance policies is, first and foremost, they maximize as much as possible the upfront cash value and also the long-term cash value. We recently put a bank-owned life insurance policy in force within the past 30 days, and in talking with the co-CEO, he also serves as the CFO, his statement was, hey, we're looking at this really at the long-term performance of the cash value. Like, the death benefit's great and all, we're hoping none of our people die soon. Granted, that happens here and there. The cash value, that's our focus. The first time around, about a year ago when they opened a BOLI policy, exact same thing. They're looking at the cash value benefit as an asset on their balance sheet. So cash value is maximized from start to finish. Company selection. What insurance company do I select? With banks, it's a little bit different. Typically, it's very, very difficult just to select one company because there are limitations as far as how much life insurance a bank can purchase with just one insurance company. So often it's spread out. But I will let you know this. In working with banks, this one in particular, and seeing other banks position their money in cash value life insurance, there's a lot of companies out there, but the go-to carriers are typically your four major mutual companies: Mass Mutual, Guardian, New York Life, and Northwestern Mutual, in no particular order right there. But that's who they're looking at, not only because of the strong financials, not only because of good-looking illustrations. The main reason why is when you look at actual performance, policies that have lived the test of time, those four companies have consistently delivered, not only for banks, but also for individuals, which we will get into as well. How a bank-owned life insurance policy is typically funded: one-time lump sum. They make a deposit. So a bank that we're working with that recently started purchasing BOLI in 2020, this was March, soon as COVID hit, interest rates, right, are coming down. There's a lot of panic going on in the environment. I get a text from one of the officers at the bank saying, Steve, we have $10 million we need to move ASAP. Guess where they put it? Bank-owned life insurance. Went through the process, different carriers, did the due diligence, the analysis. We'd actually been doing so before then, so we got ahead of the chaos that had occurred with COVID and everything going on. But at the same time, they saw what was going on. They said, where can we put the money that is safe? We're going to see it grow over time because we've got to put it somewhere. That's exactly what they did. Bank-owned life insurance. one-time lump sum. So this was back in March in 2020. At the end of 2020, I get an email from the co-CEO and the CFO saying, hey, we'd like to position another $5 million potentially in 2021. They ended up doing another $10 million after seeing the benefits again. They made a comment saying, hey, if we've got this excess money, where are we going to put it? Like, that's what they're looking to do, and this is a great area they can position money. Tier 1 asset on their balance sheets, one of the safest, most secure assets. Tier 1, that's where they like putting money. All of us like having a Tier 1 asset on our balance sheet. That's the cream of the crop right there. Safe area to position money. Strong guarantees, strong non-guaranteed values. We see it produce all the way through. Tax benefits on a bank-owned life insurance policy. The cash value grows tax deferred. Banks typically do not access that cash value. They can, but there are potential tax implications, penalties. Loan interest rates are a bit higher on bank-owned life insurance than traditional policies. Typically, they're not accessing it. Tax benefits, it grows tax deferred. However, that death benefit is paid out 100% income tax free, and banks do leverage this as a means of cost recovery, meaning a bank has employees that they're often paying for health insurance, 401k matches, other benefits to those employees. Now, if they have this bank-owned life insurance policy, which is often spread out on a number of officers and or employees, they can put it on all of their employees if they want to, that death benefit flows back to the bank, recovering the costs, usually and some as well. We always try to account for inflation, but that's how they're leveraging the death benefit. And some banks will set up what is called a split dollar plan. This enables them to give a portion of that death benefit to the officer or employee's family upon death. Some banks like to do that just for, call it good faith, trying to help their employees out that help grow the company over time. So, quick overview on how banks utilize cash value life insurance. We're going to look at an example here. In fact, why don't we do that first before we move on? So, here is a sample BOLI policy purchased with a $10 million purchase, I should say, spread out among 3 companies. We see MassMutual, Guardian, and New York Life. This is what they actually did. We just removed all of the sensitive information for obvious reasons. So in this case, what do we see? A total deposit of $10 million. This was their second purchase. Broken up between 3 companies here listed above. We're not going to disclose the companies and the actual products here, but we see one with a $6 million deposit and then spread out with the other two, $2 million deposit. What do you notice if we look at the combined values in respect to the cash value? Day 1, positive cash value. That is very attractive on their books. Day 1, death benefit, about 2.5 times the deposit. Now, what I'll add is this plan is on 30 officers, okay? So it's 30 policies spread out, or I should say 30 policies on 30 different individuals, which the bank owns the policies. The cash value is on the bank's balance sheet. The insureds are these 30 officers. So if any of them die, that's when the death benefit is paid out, comes back to the bank, and in this case there is a split dollar plan, so a small portion does go to the executives' family members. This is bank-owned life insurance. Growth over time just continues to accrue. Nice asset on the balance sheet. As interest rates adjust, we monitor the policy performance just like we would for an individual. So, main thing, here's the point of attraction. I pay money in and have a positive cash value immediately. Now, I'll add that most individual policies, this is not attainable. Maybe with a private placement, that's a bit of a different animal in itself, but with individual policies, having a positive cash value with a whole life insurance policy designed or structured for maximum cash value, having a positive cash value in the first year is not possible. The question is, how do we design it where I still have maximum cash value up front, as close to this as possible, breaking even early and seeing positive cash values? How do I mimic this model that is extremely effective as an individual? Just like corporations do. If we look at corporations and how they structure policies, typically it is individual policies that you and I can obtain that look like this. We see 100,000 per year going in. We've got about 90%, 89% of that payment available immediately. You can get that up to 95% as well, depending on the company and product. But this is a whole life insurance policy designed for individuals, corporate owned, but an individual can attain it as well. So why do banks use cash value life insurance? This is it, an area that can position their money. Imagine if your bank account could actually produce this, right? Instead, we get 0.01%. So how banks utilize it. Next, how individuals and small businesses can utilize it as well. And I want to reiterate, can I do the same thing, specifically a high cash value policy like the bank, not junk. When I say junk, is when I'm interested in a whole life insurance policy. I'm putting, let's call it $100,000 per year in, and I see zero, maybe I see 50 or 60%, 60,000 of that $100,000 in cash value in the first year. Like if I pay in 100 grand and have 60,000 there, that's a $40,000 hit. Like I'm not, as a business owner, giving 40% up. No way. Give me the money up front, also give it to me long term. That's what I'm looking for. So let's continue on here. What do we have? Cash value maximized, consistent with what banks do. Individuals, small businesses can do this. Here's the key difference. For an individual, this is absolutely critical. Policy design. When you pay any amount of money into a policy, say you're going to pay $1 into a policy, here's the thing that so many individuals are not aware of, and this is the key. That dollar can go toward one of two areas. I can pay that dollar toward the base premium, or I can pay that dollar toward what is called a PUA rider. Base premium dollars, the top portion, does not show up in cash value in the first year and often the first and second year. PUA dollars show up in cash value immediately. So really the name of the game is, how do I drive the premium down and drive the PUA portion up? If I do that, I will see more cash value up front, more cash value long term, based on actual data, and especially when looking at the guarantees, this is the key right here. Typically, the lowest we can drive that premium with, going next to company selection, those four major mutual companies, which are again, Mass Mutual, Guardian, New York Life, and Northwestern Mutual, all about 10%. They're all a bit different when you actually look at their contract language, how the policy has to be designed, but just for general terms, we can push it down to 10%. So 10% in the premium, going as low as possible. We're going to show you an example of exactly what that looks like. Now, another difference here, payment options. So if I look at a bank, what do we have over there? One-time lump sum. With an individual, we've got different options here. Typically, you cannot do a one-time lump sum. You can and avoid a MEC, but it's not that attractive. A MEC is when a taxable event occurs with a life insurance policy. We can break a lump sum up over two payments. So let's call it, we can have two payments through forever. But the beauty of it is you, the consumer, the policyholder, can customize this. So often we have individuals that want to fund a policy forever or until they're 80 years old. And then some individuals that say, you know what, I want to fund it for 4 to 5 years and I'm done. Some say, I want to move this lump sum of money into a policy for 4 to 5 years and then pay a lower amount thereafter. Everyone's different. How do we optimize the cash value, the flexibility, so it's not a burden, which is another topic which we can talk about another time. But payment options here, we have a lot of options as far as how we actually can fund the policy. Guaranteed growth. So insurance companies will often have a guaranteed rate, presently 4%, but post 7702 change, when that actually comes into play, that's going to range from 2 to 3.75%. That would be the guaranteed rate on whole life products with lower insurance expenses than what exists today. But you will always see an increase. However, on top of that guarantee, a surplus is paid as well, which gives me a total dividend rate. This is where I hear the term dividend paying life insurance. Safe area to position money. Not invested in the market at all. I remember when I was new in the industry, this was in 2012, 2013, hearing someone give a presentation that had owned whole life insurance, and 2008 came. A lot of stuff was going on then, panic, investments crashing, a lot of people lost a ton of money. This individual stated, hey, the money in my whole life insurance policy just kept going up. My dividend was 8%. Now, he didn't earn 8%. That's another topic. A dividend rate is not what I'm actually earning up on a policy. Depending on how old that policy was, his net internal rate of return may have been 4 or 5%. Still, guaranteed growth, regardless of what happens in the market, the economy, that's what he had. So it's a safe area to position money. No matter what happens, our value goes up and appreciates at a much better rate than a bank account. Liquid. Here's a fun part. I can access that money anytime I want, and there is a unique loan feature to a cash value life insurance policy. In fact, let's take a look. Let's have some fun with this. So here we've got a policy on a 45-year-old male paying in $50,000 per year for 5 years. Remember where we talked about payments? We can pay in for a long period of time, short period of time. We're going to pay in for 5 years. 1, 2, 3, 4, 5, $50,000 per year, which is a total of $250,000. There's my payments into the policy. What's highlighted here, year 3, is I've paid in $150, and at that point in time, I have $150. This is a major distinction between what you and I can obtain and a bank can obtain. First year cash value, I pay in $50,000. I've got about 95%, or a bank, you're positive right off the bat. So that is a difference there with the initial cash value. Aside from that, we accelerate it as much as we can, which drives compensation down to the absolute minimum. That's a must. And then what happens? It just continues to grow over time. Now let's talk about the unique loan feature. So we can loan from a policy anytime we want. Typically, when we request a loan, it's going to be 3 to 10 business days, 3 to 5 typically, if everything's in good order and we've waited at least 10 days after making a deposit to the policy. But with policy loans, you hear the word loan, usually what comes to mind? Payments and interest. The reality of it is there's still interest, but payments are optional. You can pay it 100% at your discretion. You will find that it's often in your best interest to at least make the loan interest payments unless you're in retirement and just taking income. But if we have any intention to pay it back and we can swing the loan interest payments, it would make sense from a performance standpoint. But here's what I want to look at. Unique loan feature. Here's what I'm talking about. Once a dollar passes through the cash value of a life insurance policy, that dollar is forever at work for me. So I borrowed $200,000. My cash value is my equity. Call it your line of credit if I want to compare it to that. Pull out the $200,000, cash value is $53K. When I didn't touch the money, $263. So this policy, this example, has a loan interest rate of 5%. What's 5% of $200,000? $10,000. That's why I see the $210,000 drop. This year, we made no payments at all the year we pulled the money out. Now, again, I just want to reiterate this point. A unique feature to a cash value life insurance policy is that once a dollar passes through the policy, it's forever at work for me. No lost opportunity cost. Keeps on compounding. I have the loan interest that goes to the insurance company, not back to myself. If I have a mortgage against my property and my property continues to appreciate, continue to receive the appreciation on my entire property value, but the interest rate on that mortgage goes to the lender or to the bank who has a big BOLI policy. When I borrow, what happens to my death benefit? Reduced dollar for dollar by the amount I take a policy loan. This is how they continue to pay the same dividend rate and guaranteed rate on my entire bucket of money. So here's what I want to look at. We repay the loan in this example at $50,000 per year. We can pay it back however we want. I could pay interest only and then throw a lump sum of money at it. But if I tally those payments up, what do I have here? I paid $200,000 back, plus call it another $29,000 in total loan interest that went to the insurance company. If I stop there, it doesn't make that so much sense, or it doesn't feel that good. However, here's what I want to look at. When it's paid back, what's your cash value look like? And what does your death benefit look like when you compare it to the example where you pumped money in and just let it sit and grow? Fully restored to exactly what it would have been as if I never touched it in the first place. Look at your dividends here and compare them over here. When that loan's outstanding, do you see any adjustment in the dividend? None whatsoever, consistent in both examples. So that unique loan feature, a lot of people that we work with and people that own cash value life insurance will leverage that heavily. As opportunities arise, instead of making purchases in cash, they will leverage the funds from their policy. If they're uncomfortable with the loan interest rate that goes to the insurance company, we've seen this lately in the low interest rate environment, is one will go to a bank or a lender and assign the cash value as collateral to obtain a much more favorable interest rate. And then if that loan is for business, that brings in other potential benefits. So here we go. Liquid, touched on the loan feature. Tax-free. Tax-free if, it's a big if here, because I don't like to just say it's tax-free for marketing purposes. No, Steve. Got to be transparent here. If we do everything right, meaning if we don't just cash the policy out with a gain, the gains would be taxable in that case. If we trigger what is called a MEC, Modified Endowment Contract, that can result in taxes and penalties if we access the money prior to age 59 and a half. We have other content on that as well on our channel. But if we don't trigger a taxable event, we can use it tax-free. It's very easy to avoid a taxable event. And then the death benefit is often used for legacy purposes or income protection. If I take a policy out, I've got policies, I'm 32, almost 33 right now. If I die, it's meant to replace the income that would be earned in the future years. This way, my wife, family, business, employees, everyone's protected in that sense. So that's where the income protection comes in. Legacy planning is that large death benefit to leave everything in the most efficient manner through life insurance proceeds. But again, here's what everyone is always interested in. I'm going to circle back to the original point. High cash value, like the bank. That's what I want, not junk. So let's go back. Bank-owned life insurance policy. When we look at that guy, where is it? Too many things up at once. Okay, so $10 million purchase, here we go. What happens, here's a case where an individual was proposed a policy, this was not through us, and he was looking at funding a policy at $100,000 per year for 4 years, and then just $40,000 per year thereafter. So $40K per year is what he is comfortable with cash flowing the policy. However, he's got some money in his bank account now that he'd like to move into the policy. So here's a policy that has what is called a 40-60 split, meaning of that $100,000, $40,000, 40% is going toward the base premium, of which nothing shows up in the first and second year. Pays in $100,000, he's got $63,000, $64,000 to show for it. What's highlighted in yellow between years 8 and 9 is when he is breaking even. When he has more money in cash value than what he's paid in. Looked at this, yeah, I'm not doing that. That's what happened. Put it on hold for several years, eventually starts researching it again, looks at different options, stumbles across something like this. Voila! Same company, same product, same individual, same health rating, everything pulled directly from the insurance company's illustration software. Only difference is right here. Different design. 10% base premium, as low as we can go. $100,000 in, $10,000 base premium. That means approximately $90,000 is going toward that PUA component. Look at this, 87% right off the bat. This is a traditional long-term policy. If we want more money up front, we could use what is called a high early cash value product. And there's pros and cons to both. But what's the difference here? Now he's breaking even almost year 4. Year 5, he's positive. 440 in, 447 in cash value. Continues to pump money in. What do we see over time? Is there a difference? Absolutely. Big difference up front. He has access to the capital. He says, you know what? I'm comfortable with that. That's a smaller hit because it is money in my bank. I'm not doing much with it anyway. I'm comfortable with that, and I quickly make up for it. Okay, let's move forward. We showed him much more options than this, though, as we always do. As time passes, what happens? We go as far down as we'd like. End of the funding period. Same company and product. This is so interesting. I've got about 60 grand more or 50 grand more in cash value. No, I'm sorry, it is 60 grand more. As compared to the same policy with that higher base premium or insurance expense, we can call it. Now, what happens when I'm 85? 4.8, 4.9. Which one do I like more? The one that can optimize my cash value and doesn't trigger a MEC or any kind of taxable event. We've got other content on that. Here's another case study. Individual wanting to look at all examples. When I say all examples, this is one policy here on a 40-year-old male looking to move in $2.5 million to a cash value life insurance policy. Big amount of money. Same thing with policy design. Minimum premium, 10%, $25,000. A little bit less in this example, actually. When I say see all the options, this is a fun part here. Looking at the guarantees. You think banks look at the guarantees when they look at the bank-owned life insurance policies? Yeah. When we work with them, that is, I jump to that and say, hey, here's the guarantees, here's the non-guarantees, here's what's happened over time, complete transparency. If I just show the good-looking numbers and ignore everything else, and then it produces closer to the conservative numbers, when I'm expecting the good numbers, then I'm not that happy. If I see everything and it's transparent, I know what to expect or I have a good sense of what it will do, okay, now I'm happy, I'm prepared for the actual performance. So important, that's just communication really more than anything else. So what do we got? Guaranteed rate, gross at 4%. So that's the gross guaranteed rate of 4%. Gross dividend rate of 5.65%. Indexed feature assumes it's closer to about a 6% gross rate. Why I am emphasizing that gross rate is anytime we see a guarantee of 4%, a dividend of 5 or 6%, whatever it is, we always want to be aware of the fact that that is a gross rate, not what I'm actually earning. It is a gross rate credited after the company's insurance expenses, after the mortality charges. What I'm interested in is the internal rate of return, the actual growth on the product. Now this represents the annual internal rate of return, which only isolates each year what I'm growing. It does not factor in the 10, 20, 30-year averages. If you'd like more info on that, I'd defer you to our internal rate of return videos on our YouTube channel. Based on the guarantees, breaking even between years 6 and 7. Annual IRR, tax-free if I do everything right, tops out at about 3.34%. That's solid in my opinion. 2021, hard to find a bank account for 0.3%, depending on where you bank. Dividend, which is exactly what they're doing and what they have been doing, positive by year 4. Look at that. Cash rich right off the bat, minimize the insurance expenses to negate that hit. Sizable death benefit, $10.5 million. Where that comes into play, going back to that MEC limit. That's exactly how we came up with that death benefit. What's the minimum amount of life insurance I can have and still have the IRS view the policy as life insurance, not that modified endowment contract I have to deal with taxes. Breaking even, IRR tops out at a little over 4%. And then over here, again, this is the same policy. There we go. crossing over the same year 4, funding it for 10 years. Now, if the individual says, you know what, I might want to continue funding, but at a reduced amount, here we go. Exact same policies here. He just keeps pumping money in up until age 65 at $50K per year. And this is the kind of stuff you can do when we design these policies, which, by the way, I love. After 10 years, if I still have money I want to continue to pay in, chances are I'm going to do that, because look at this. I pay in $50,000. It grows from 2.67 to 2.795, over $100,000. Well, not quite. That total growth there is over 100 grand, about 120,000 there, 130. Back out the 50,000 though that I paid, so the actual growth is about 70 grand. The dividends and the compounding inside the policy. Try to be transparent as possible there. Point is, if I'm considering a new policy, but I have money and I can add into an existing policy, that makes way more sense. Why would I go through those insurance expenses again if I have room in an existing policy, unless there's a need for more death benefit, more mech space? There could be a reason, but always consider funding an existing policy. Same thing here. And then lastly, let's look at a high net worth individual. These type of policies can be obtained for individuals in most cases. The thing is, this example has a minimum premium requirement of $100,000 per year. So not everyone can obtain this, and it's attractive. Started with $1 million, 97% right off the bat. This is a whole life insurance policy, non-mech, they have access to it, breaking even between years 3 and 4. Then we've got this example, which anyone can attain at any funding level, 95% right off the bat. Breaking even just about year 3, really year 4, I'm positive there. And then we've got the internal rates of return, and then the taxable equivalent, meaning if I have an effective tax-free rate, what would I have to earn in a 40% tax bracket to have the same equivalent tax-free? Meaning, if I'm earning 7% and it's taxable, after I pay taxes, what will the net IRR or net return be? A lot of times we like to compare that. Not to say life insurance is the best thing ever, put all your money there. No, everything has a place, pros and cons. Important to emphasize that. Just like banks do not put all of their eggs in one basket. So a lot of examples here. Going back to this, how do I copy this or mimic it as closely as I possibly can? That is very important to do. And it's possible. So can I do the same thing? I would say not the same, but similar. That's the key. Having enough information. The examples we went through there were with different companies. Right? On our public channel, we don't go into all of the company details with comparisons. Insurance companies don't always like that. If you're a member, you've seen some content on that, or if you're part of our Agent Academy, or if you work with us, you've seen different examples. But that's why we didn't go into company names there. But very, very similar. That's what we can do. When we set policies up for corporations, those examples, not the bank-owned life insurance policy, but the other examples for small businesses, corporations, is often what is set up on the higher level executives. A lot of companies will do that for key man coverage, executive benefit, planning, golden handcuffs, which we've got other information on. And anyone can obtain it, to be frank. So a lot of info here. I went at a fast pace there. I do hope that you found it helpful. If you have any questions or would like to see samples, feel free to connect with us or reach out anytime. We'd love to connect with you. And as always, I hope this helps. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.